Good morning, everybody. I'd like to welcome you to our recording on key performance indicators. These are tools that will help you understand whether or not you are successful in your business. And today on our presentation, these are the parts of a business plan. And to find out how successful you are with your plan, you need to use these key performance indicators. So they kind of encompass all of the portions of your business plan as you are going through your business, getting it set up, getting it expanded, doing all of those things that you need to do to make your business successful. Today, to help us with our presentation, we have Sybil Eggy, who is the director of the Illinois Small Business Development Center at Elgin Community College. And Sybil has spent many years in business management and consulting. She has been an employee and a business owner, so she knows both sides of the coin when it comes to running a business. Sybil started as a business advisor for the Illinois SBDC at ECC in 2008 and graduated to become the director in 2011. I'd like to welcome Sybil Eggy to our presentation this morning.
Well, thank you so much for having me on this particular discussion. Key performance indicators has always been a strong interest of mine, and I always lecture my clients on the benefits of them, so thank you for the opportunity.
You're welcome. So why don't we get started with telling the audience what a key performance indicator really is.
A key performance indicator is something that is going to help you keep a pulse on the business. We think of the financials as being the heart and soul of the business, and you have to look at those very carefully, at least that's my recommendation, on a monthly basis. But sometimes there are other pieces of information that you can use that is not totally financially oriented that you have access to on a daily or a weekly basis that will give you a more current pulse on the business so that you can manage various aspects, and you only use key performance indicators that you can actually track and measure.
All right, great. So as we move forward in our presentation, let's talk a little bit about what we would do with KPI. And we're going to call them KPIs now for short because key performance indicators get to be a little bit long.
They do. The way I have my clients do this, and actually this was how I was trained way back when I was in corporate, I had to measure certain pieces of information weekly, and I had to review them, and I had to be able to talk about them to my management on a regular basis. They are, for example, I'll give you a quick one. I was in information technology in the software development area, and I managed large software development teams, and we did a lot of custom work for our clients. So one of the things we had to measure was what we call billability, and this is a common productivity measure that any service organization has to track, such as accounting firms or lawyers. So we had to fill out timesheets and track how we spent our time, and of course what was important was the time that we spent billable or non-billable, and if billability fell below 85%, I heard about it, and not in a good way.
Well, and that's one of the things that we need to make sure for those of us who are consultants. Billable hours are a huge key performance indicator.
Mm-hmm.
So let's talk about what KPI is not. And it's in that little red box on the screen.
The Yes, what we have in that little red box is the metrics that you're using. They have to be absolutely clear. They can't be vague. They have to be very concrete. They're not just nice to know. They're necessary. And they're not things like a list of the top 10 most important things I have to do this week. That's not a KPI. And they can't be so extensive that you get lost in lots of numbers. So we suggest that you limit the number of KPIs that you follow to something that's really relatively small. I actually think the 5 to 8 might be too high, but at any rate, certainly never more than that. And refutable, yeah, we got to be able to prove these numbers.
All right, great. All right, so we've got a couple of different types of KPIs, and we're going to go into each of these a little bit more in detail, but do you want to just talk just very briefly about what these each are?
Okay, so operational and productivity gets to the business of the business. What are you producing? What are you selling? So we need to know how effectively you are running the operation. Financial is how effectively are you measuring your financial performance. People is always how effective are they at doing their job. And marketing is how successful are you in getting the word out about your product and services. I think we can go on.
Great. So
okay.
What's the different things that we could include in those sorts of areas would include the things that are on our screen now?
Absolutely. It's just about every piece of data that you could think of has potential value. And I know retail operations who are looking at their daily revenues and comparing that to other, a KPI is essentially a comparison or a formula that measures two things. It's usually two pieces of data. So I've seen retail people check those KPIs on a daily basis so that they can correct their business as quickly as possible, because that's what they're supposed to be able to do, is to give you early warning if things aren't happening at the rate that they should, so that you can take that immediate corrective action.
Sure, right, exactly, and that's the whole thing. If you wait too long,
it's too late.
Yeah, exactly.
Right.
Okay, so let's talk about some examples that we have for each of these different areas.
Okay.
And this first one is on operational.
Right, and I already talked about the billability for a service organization. It's taking your billable hours and dividing that by your standard hours per week or month. You don't want to include overtime because that's going to confuse the issue. So if you standardly work a 40-hour week and somebody's working 30 hours, that's going to be a 75% billability, and that may be right or too low. But somebody may be working 60 hours a week but being billable 30 hours a week. That gives a billability, if you use the 60 number, of only 50%. So that's why you've got to keep it clear what the rule is for the calculation.
Sure.
Okay, for the average transaction price, that's pretty simple. It's the total sales for a period of time divided by, the actual total sales divided by the number of transactions. Is that right? Yes.
Right. Right.
And then the average inventory, this is interesting. I think a lot of companies who are selling product do not have a good handle on their inventory. So you need to associate what's in inventory with something else, okay, to make sure that it is turning over at a reasonable rate. And So in this example, I say take the dollars in inventory and divide that by the sales per month or per quarter, okay? And so that you could measure that periodically, and you could, for your own business, determine what is the good number that you're looking for. And if you measure it on a routine basis and it's too low or too high, that's going to tell you the story that you need to help you make the adjustment. And I added, go ahead.
There was a thing that we used to do. I used to work in the stockroom at Target, and we used to try to keep as many items in the store as we would sell within a 4-day period, because by the time that it went through the register and then went from the warehouse back to the store, we always needed to keep a 4-day supply. And so if you've got a 3-week supply, you don't want to order. And if you've only got a 1-day supply, you could be losing dollars.
Yes, absolutely. Now, I gave a little example on the right of how carefully you can look at your numbers. So let's say your business is manufacturing bolts, and you have in the past 3 years been selling your bolts to your customers in 25-pound boxes. But you're now waking up to the fact that your typical customer is buying at least 50 pounds at a time. If you ship 20 boxes in a month and the cost is $468.60, the average cost per box is $24.33. If you instead pack each box with 50 pounds of bolts and send 10 50-pound boxes instead, same number of bolts, the cost is going to be $407.20 for the shipping, okay? So the average price per box went up, but your shipping costs went down.
So in general, you save, right?
Yeah, because the labor is the same, whether you pack a 25 pounds or 50 pounds. You're just putting it in a box, and it's going to take them the same amount of time, but you're going to save $60 if you can routinely ship 50-pound boxes.
Right. So that's a KPI to calculate for your business.
That's right.
So for financial, these are always tougher for me, but.
Okay. Yeah, I know a lot of people struggle with the financials. There are 2 measures here. Well, all of these are really important, okay? The first measure is the rate at which your company pays off suppliers. And that's the word or the expression for that is accounts payable turns in days. So how many days does it take you on average to pay your suppliers off? And believe it or not, this is very easy to extract from your monthly financials. I'm not going to go into that in this discussion, but it's right there in front of your face if you understand how to do it. Then the second rate is how to measure how quickly you are collecting your outstanding accounts. So that is called account receivable turns in days. So I have a little story. I was talking with one of my clients recently, and they went to a class that I teach. It's called Profit Mastery. And in that class, they learned how important it is to reduce the number of turns in days it takes before you are paid by your clients. So they had initially given all of their clients terms of 30 days. And they were hurting. Their cash flow was a problem. So by cutting their terms down to 10 days in lieu of 30 days, they were able to get their cash coming in much more quickly, and it made a big difference in the way they could handle their cash. So keep that in mind. Don't be so gracious as to give your customers 30, 60 days. I know sometimes you can't help it because they set the targets for you, but try to negotiate that to as low as possible. And the last
Yeah.
one is pretty conventional. It's measuring how effectively you generate profit based upon every dollar that you receive in revenue, and we call that net margin. So, unfortunately, sometimes that's a negative number, which means you're not having a terribly good reporting period. But if it's getting to be positive, we want to see what is the net margin you are establishing. So you could, when you budget for the year, say, I want to make a net profit and those words are interchangeable, net profit or net margin, of, let's say, 5%, and you're tracking at 4.5, you're almost there. If you're tracking at 12, you can have a party.
Yep.
Everybody wants that. Okay.
Yeah, exactly. So how about some people KPIs?
Okay. Now, this is a KPI. I've run across it twice with two different retailers that I work with. And it's really a very simple number. You take on a daily basis, okay, you can take your sales staff payroll per day divided by the number of items sold per day, and that will give you your average item cost. So here was the real example. The customer I'm talking about sells ice cream. And she decided that if she could get an average item cost of 85 cents per scoop of ice cream, she had balanced her staff perfectly. So if it was lower than that, that meant the staff was running like crazy trying to satisfy everybody, and she was probably understaffed. And if it was a lot higher than that, she had too many people at the front counter. So that turned out to be very effective. The next one is something I experienced also in the software industry. It's the number of defects per individual in a given time period versus the average allowable number of defects for all performing the same job in the same time frame. Now, this is useful for manufacturing or anything where you're, and software development is actually a lot like manufacturing. So if you're NASA, you can't have any errors, okay? But if you're a software company, you don't want to ship your software with known errors, but it's almost impossible to get it to be clean at a reasonable cost. So you might say, we can ship it with 2 known software problems, okay? But that's because you've got your staff working at the appropriate level. They're spotting errors and correcting them. But if you have one person in particular who notoriously is getting, 5 and 6 errors, there's something wrong with his work. The quality is missing. So it's a good quality check.
Sure. So marketing is near and dear to my heart.
Right.
But what do we do with marketing KPIs to make sure that we know what we're doing?
Well, I love this leads to close ratio. Think of that as I'm focusing on the second item, which is cost of customer acquisition. And I, some time ago, came up with a spreadsheet that says for all of the various techniques or types of marketing I do, I need to be aware of what's the potential number of leads or clients or prospects, and you can decide how deeply you want to take this, how many you can get using each of the tactics that you specify. And sometimes people will say, well, this doesn't cost me anything to do. Let's say networking in particular. I can go to a networking event where it's free, and there are a lot of such events. And you go there, and you might meet 20 people and take home one real potential, and that may evolve into a customer. But in order to get to that networking event, you have to drive 45 minutes to, 45 minutes back. You're there in the meeting for an hour and a half, so that means you've spent 3 hours away from your work. Was that worth the effort? And the only way you can know that is you assign a dollar value to your effort. So you might say that my hourly rate, even though you may not be paying yourself this hourly rate, is actively an effective rate of $35 an hour or $50 an hour. So when you apply that on a time basis, you can see how important that time spent is to you. Does that make sense?
Yes. Yes,
Okay.
I think you did. Well, we can poll the audience. Did she make sense to you? If you want to raise your hand with the little man at the top of the screen. Did Sybil make sense about the networking? All right, so it looks like you did. All right,
Okay.
So let's talk about the next item.
Website is social. This is actually your bailiwick, isn't it?
Yes.
Why don't you talk about it?
Well, one of the things that we do when it comes to website or social traffic, everything that you do in social, you want it to drive back to your website, and then you want to be able to have your website initiate calls or emails to you about your product or service. So you would measure how many phone calls, emails, contacts from your web or social are you getting to a potential lead. And so you need to have some sort of lead tracking software so that you can measure that, and it becomes that way that you then turn the next step from the leads to close ratio. And you also have to know what your lead time is on your product closing so that you make sure that you're knowing that, okay, well, I got this email from this person, but it really takes me 9 months to close a sale. How can you speed that up, or is that what it is?
Right. I think I used to do a lot of cold calling in one of the small businesses that I had. That's all they did all day long was cold calls. And it's important to know if you have to have an understanding of your market and the ability to connect with the market. So salespeople understand it's just a numbers game, so they may recognize that for every 100 different unique customers or prospects you call on, it may only lead eventually to 2 to 5 closings, okay? Maybe it's less. It depends what it is that you're selling, the amount of the item or service that you're selling, and so forth. And I agree completely with the time it takes. So a lot of organizations who require sort of cold calling up front, they create a funnel and they understand, well, getting from the cold call to the first meeting and then to the second meeting and then to the third meeting, getting to the presentation and then getting to closing the deal could take a period of time. So you have to take both the time and the number of touches before you can assess whether it's reasonable or not.
Okay. We have a question from the audience about cost of customer acquisition. Could we give another example of the cost of time?
Oh, let me think.
Expense and time. And I liked the example that you gave of how long it takes you to get to a networking event. Maybe I can give an example here. One of the things that I do is I try to meet my clients so that I can see them face to face, because it's so much easier to read things on somebody's face than it takes to do it over the internet. You can't always see that curiosity look in their eye. So one of the things that I like to do is I like to meet them, but just as the example that you gave with the networking, if it takes me an hour to get to that client, I meet with them for an hour, and then it takes me an hour to get back. That's actually 3 hours out of my day. I really can technically only bill them for 1 hour unless I say up front travel time is included. And if you notice, photographers may often say, I charge you 8 hours for the event plus an hour travel time each way. So that's another way that you can consider what that cost versus time and expense aspect is. Now, we are talking about marketing, but it can translate to closing that sale or actually performing your job as well.
Right, and yeah, we should mention, that there are some types of activities where it doesn't take you any time, but it costs you money.
Correct.
So, okay, so let's think of you're doing some sort of internet marketing and you're being charged $300 a month for some type of service to funnel leads to your website. And so all you had to do is pay $300 a month, and these leads hopefully come to you via your website. So the question is the number of leads that you're getting from the website sufficient for the $300? Okay? So
Great example.
So when I do a marketing budget, and I know, unfortunately, most people don't do a marketing budget, so I encourage everyone to do it, is to say, here are all the tactics, how long is it going to take me at my rate, how much is it going to cost, either it's nothing or there is a fee, how many people do I expect to get from that source per month, so you pick a period of time, and then how many do I think I convert to a prospect and then convert to an actual customer. And it's not a very difficult spreadsheet to calculate, but if you do that and then implement those tactics and count what exactly happened versus what you thought happened, that's where you figure out, oh, this was a bummer. I should not have done that classified ad. That's worthless. Get rid of that. Cost me $600, and I only got one person coming back to me.
Right, right. So you have to count the time versus value.
Right.
Now, let's talk about lifetime value of a customer, because I think we did not cover this point.
Yeah. This is an important one. It depends what it is that you're selling to your customer. I was a franchise broker for a period of time, and they only bought a franchise once for me. So I didn't I was always looking for brand new customers. But Dee, what's your experience on this? How do you find this working for you?
Well, a lot of times my clients can tend to be one and done as well.
Oh.
But there are updates that come out or new ways that something comes up. And so if I can approach that as a proactive opportunity to help train somebody on this new sort of opportunity, that becomes the lifetime value of a customer.
Right.
So knowing the difference between whether you are a one-time purchase or whether there is a possibility of getting repeat business, and how can you create that repeat business. Maybe it's when was the last time you updated your website, or when was the last time you updated your software. Depending on what it is that you're selling, you need to know whether or not you can create that repeat business.
It's worth pointing out that in order to be able to calculate something like the lifetime value of a customer, you have to have a database where you're tracking these contacts with your customer, okay? It shouldn't be something that you have to go to a file cabinet to count, well, how many invoices did I send to them over the last 6 years? you need to have that readily available. Because I think that's a worthwhile piece of information to know that a customer, I keep them on, 70% of my customers I've had for 5 years or more. And it might be a fantastic number because it's so much more expensive to get a new customer than it is to retain an existing one.
Right. And if you're billing somebody monthly, I know there's a term for this, Sybil, and it is escaping me. But if you bill somebody on a monthly basis for a service,
Mm-hmm.
there's actually a term for that, and you can count on that income.
Right.
But you have to be providing them a good service so that you can
Absolutely.
retain that.
It's wonderful if you can manage that. Okay, and yeah, it's kind of like a retainer or a maintenance level, something
Correct.
like that. I know
Correct.
there's a special word and I can't think of it either.
We'll post it in the news article after the webinar.
All right.
So let's talk about why KPIs are important.
Okay. First, they're going to help you identify trends. It's not sufficient to just look at, well, I'm making the same revenue, okay? Month after month, I'm hitting my same numbers. I think you really need to count what it is that you're selling on a daily basis. So I'll talk about the lady who sells ice cream. She's so attentive to this daily average ice scoops sold that in the event it changes significantly, she beefs up her marketing, her online marketing. She sends out an email blast with a coupon. Come, I need to drive customers into the store. So that's why you need to watch it on a regular basis. Improving decision making. In the case of the billability per week, do I have too many people on the floor who aren't working? In software, we used to call that, and software consultant, we used to call that, do I have too many people on the bench? Sometimes they called it on the beach, meaning that they were just enjoying the sun and they weren't creating any billing for the company. So if that goes on for too long, you have to swallow hard and say, I need to lay you off, or I can't do the hiring that I anticipated in the next month.
Right.
It can also be an alert when something is really wrong. If I think the example that you used previously, if you're tracking your inventory and you find out that you only have one item left and it takes 4 days to get new ones out to the retail operation, well, wouldn't that be nice to know before you only had one left?
Right, exactly.
Right.
All right, so let's move to the steps that we can create a KPI.
Okay. I like this chart. Let's tie it to your overall goal of whatever your goal is for the company. Maybe it's to make a certain profit margin within a period of time. Let me just say for the record that I encourage people to budget. A lot of people don't like to do it, but it's a very good exercise. And you want to budget on a yearly basis and look at where you are month to month to see how you are doing based upon what you thought you would do. So you would set up your budget with a variety of assumptions. And when I have people do budget, I'll also ask them to budget their KPIs, okay? So in the case of the ice cream person, their budget was 85 cents a scoop, and she tracked it every day, and we looked at it from a monthly basis, and then she would be able to see whether she was staffing properly or not. And of course, the KPIs have to be meaningful. Don't just do it to put two numbers together. They have to be a way of measuring the productivity, the quality, the responsiveness of the market to whatever it is that you're selling. So they have to be measurable, and you have to set the period of time that you're going to use to do the measure, and then you have to have the proper tracking tools. In a retail environment, you would use your point of sales machine. It's going to capture the data most likely that you need. In other cases, it might be your time cards. You know, you have to have somebody always review what the people are putting in on their time cards. Sometimes they overstate, so you need to do that properly. You have to count defects, so you have to do the counting and establish a spreadsheet, a process, and a monthly review. How did I do? Now, I said earlier, you may be looking at these KPIs more frequently than once a month, but certainly every month, look at the KPIs and compare them to what you hope to achieve versus what you actually did, the same way you would look at your financials.
Great. So now let's step into each item. Mm-hmm. We want to tie into overall goals.
Right. So this is a good one. You know, I want to increase profits by 10%, but I would add increase profits by 10% within some period of time. Maybe that's a goal for the first 6 months of the year, and you're going to be looking at the profit at the end of the prior period, which might have been 8%. And if I'm tracking my financials, I can easily see that number. That's pretty much the bottom line number, and you can do you can calculate that percentage to see, did I meet the 10%? That's just a 2% increase. Did that happen?
Right. So we want to make sure that we're picking one goal at a time, right? But we may want to track more than one goal, but each goal is going to have a specific set of these systems, and so we may have more than one goal.
Right. I don't want to impose too many measures on people. If you say I want one operational goal, one financial goal, one HR goal, and one marketing goal, I'd be happy with 4.
Okay.
You know, it depends what your business is.
Sure, exactly. All right, so now we need to know what our key business drivers are, and do you want to talk about the list here?
Okay, utilization is, I hope that's clear. Use of something within the business. Are you using something effectively, or is it sitting there and not being used? The defects we talked about before, it's an indication of quality. Cost of goods sold is, this is a number that people have trouble getting to sometimes. If you wanted to know whether or not your margins in your business were good, and if you only look at the raw material cost and you don't consider dedicated labor to produce that product, you're missing something. So cost of goods should or can certainly include everything that it takes to get that product out of the store, okay? It could include shipping. You know, if you're, in particular, if you're not charging your clients for shipping, you would certainly want to know that. Competitor prices are, everybody would love to know what the competitor prices are, and people ask me, how do you do that? And I said, you have to pretend and call a competitor and see if you can get some information. It's not always easy.
Right.
Yeah. Pricing, I find that people are shy to raise prices, but if you think about it, if you're running an operation and you are getting a profit of, let's say, 1.5%, and you increase your prices without doing anything else, your profit will increase. It goes straight to the bottom line. So don't ignore that. Your prices should raise probably once a year, sometimes twice a year. Everybody else is doing it, so why aren't you? And the last thing is Salesforce costs. Oh, that's tricky, you know. Everybody would love to be able to hire a salesperson and give them 100% commission, and every salesperson out there wants to get hired with a base salary. So, but it's something that you can control and has to be good for your business and for the type of sales that your sales staff would do.
Yvette made a point here in the Q&A. Sometimes the perceived value of a higher price drives a good to sell more. And we've noticed that here with the Illinois WorkNet webinars, we don't charge for these webinars. And so sometimes people register but don't attend. And
Right.
A lot of times that word free causes people to see that there is no value. So a lot of times we say prepaid when it comes to services that are funded through government grants and things. But that does bring a good point. If you devalue your product or discount it too much, it could be a challenge to making more money down the road.
I'm glad you brought that discussion up. I have a view on that. The Small Business Development Centers in the United States are funded by the SBA and the state and sometimes the institution at which they reside. So when I say that I provide counseling at no charge, I said, you've already paid for it. You're a taxpayer. You've been paying for me. You might as well use the service. So that's one view. As far as workshops or webinars that are no charge, I always, I shouldn't say always, many of my workshops are at no charge. And I've just come to accept the fact that people will sign up and they won't show up. But there's a certain level that I'm looking for. If 50 people sign up and I get 30 in attendance, I'm thrilled, you know.
Sure.
If I only had 10 sign up, I would worry more than, you know, I want as many as possible because I know there will be a drop-off rate.
Right, right. Well, let's move on to the next step in our KPI. We want to ensure that things are meaningful, and we want to talk about things that we can control versus things that we can't control, and it becomes a good balance.
Right.
So let's talk about these items.
Well, I personally believe you should be able to control the top 5. The only thing you can't control is what your competitor is doing. You can try to match him if that makes sense for your business. You know, again, in this profit mastery class that I teach, we talk about how do you set your prices. And somebody answered in the class that, well, I set them based upon what the competition is doing. And the instructor said, well, that assumes that the competition knows what they're doing.
Haha, good point.
Okay. So they can, and in keeping with our prior discussion, sometimes raising the price gets people to take that thing off the shelf faster than you can put it up there because they think, oh my God, this is great. So go back to the example of the ice cream retail operation. She was selling these cones. She caters to kids. And they're called sparkle cones, and they're a waffle cone that she dips in some sort of, you know, let's say a chocolate, and then she puts sprinkles on the outside. And she might have been selling them for, I don't know, I'm going to make up the price, $1.50. And we said, are you crazy? Sell that for $2.50. The kid's going to go in and see them, Mommy, 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 I want it. And now you have increased it enormously, and they'll fly off the shelf. And they did. Just raise the price, and you may be able to sell things better than if you lower the price.
Right. One of the things when you mentioned about setting prices, it brings to mind gas station wars, kind
Oh,
of.
yeah. Oh,
When there's one on one corner and one on another one, you see the prices shift just because they're selling it for that price. But
right.
who's right?
I don't know. Who's making money is really the issue.
Exactly.
Okay.
And we want to
You
make sure that KPIs are measurable.
Right. So I've given you a utilization example. If you have something, whether it's, and this is a car, a rental car, it could be a piece of equipment that you're using on a production line. It could be a programmer writing lines of code. If they're supposed to be available for a certain length of time, but it's not used for that length of time, then your utilization is lower than it should be. So it's good to track it. Defects, I think we talked about previously. I'm not sure we need to add anything else.
All right, great. So we now want to set measurement dates, and you were talking about what makes the most sense. I know
Right.
that my daughter works in a retail store, and they track things hourly.
Oh,
Your ice cream lady tracks things daily, is it? All right.
daily. Others do it weekly.
So we want to make sure that whatever we're doing is how quickly you're measuring, because it makes sense on how quickly you need to make change, right?
Yeah, what I would probably say that you should always be tracking these KPIs on a monthly and annual basis for sure, okay? And probably year to date, potentially. It's the top three that you have to use wisely in your business. Hourly will not work for a lot of operations, but daily and weekly I think are the two most common on the shorter period of time. And then you can easily roll them into a longer period number.
Sure, exactly. And last but not least, we need to establish proper tracking tools. And is it a clipboard with a set of boxes to check, or what's the tool?
Oh, you're asking somebody whose life was spent 30 years in software, so I'm going to say you need a database. Yeah, I mean, you should be tracking these things electronically. At minimum, develop a spreadsheet. You know, if you have, let's say you do time reporting, and so your personnel are filling in a timesheet by hand, then you as a manager or somebody needs to take that and put that into something electronic for posterity and for evaluation later, because that data is so worthwhile in ways that we haven't even discussed.
Exactly.
And so you can't delay about it. You know, if you say I need to track this daily, do it daily. If it's weekly, do it weekly. Make sure it's accurate. I use that example of somebody filling in a timesheet. Make sure that the manager who is closest to that employee is reviewing it. Don't assume that it's right. The type of errors are not necessarily intentional. Maybe they charge the time to the wrong clients. They use the wrong account number. And
yes.
it would be embarrassing, you know.
Right.
And I added to this list the word trended. Trends are vital, so you shouldn't just look at, well, how did I do this month, then how did I do next month, and how did I do the month after. Put the 3 months side by side. And if you're clever enough, and you can do that in Excel, you can even graph it. And so it's important to see that, because sometimes it's very subtle. I was working with a client recently where the revenues kept going up, but the expenses were pretty steady. And the expenses were pretty steady. That's an important story to know. But if you look at it month by month or year by year, it won't pop out at you in the same manner.
Right. You also need to take into consideration things that are happening in the environment, the economy, in weather. If you're a lawn mowing business and there was snow on the ground until the beginning of May, and you're normally, or a golf course, if there's snow on the ground until the beginning of May, and you normally have people out playing golf as early as March sometimes, that's going to affect your bottom line, but it may not be the same thing every single year.
Right.
So knowing what's trending and what's happening makes a big difference.
I use all of these fast food franchises. They're sending data back to the franchise headquarters probably twice a day or hourly, I'm not sure. But one of the pieces of information that has to go back is going to be what was the weather outside.
Exactly. Exactly.
Have to know that.
All right. So evaluation.
How will you use the data you receive? Okay. You should be using it on a regular basis. I teach my clients that they have to have a formal sit-down with their management team once a month. And look at the financials versus your budget, compare that to how you did the same period last year or maybe the prior period, and do the same with your KPIs. And if you trend it, you're going to see, well, what a surprise, that you're selling certain things much more in the summer than you are in the winter or vice versa. And take into consideration where the economy is, and just, you should be able to know your sales cycle. That we're high in the last 2 months of the year, and we're down in January. February is barely moving up, and then things seem to recover by the time we hit April 1st. You need to know those things.
Right, right. And then how can you take any actions related to make sure that you're adjusting to the things that you're finding out in the numbers?
Always, always.
All right, so we seem to have answered questions during the course of the presentation, and we appreciate you participating willingly in this presentation. If you have any additional questions, please type those in the Q&A. I'd truly like to thank Sybil Eggy for sharing her knowledge and expertise during this webinar. It was invaluable in many cases, and because it's being recorded and will be shared, many other people will be able to find out more about key performance indicators.
Well, thank you so much for having me on. I enjoyed it.
Well, you're welcome. Now, if you could take a moment, if the participants here could take a moment to complete our surveys, we do have links to a number of items that, in case you need them, they are available here. And as always, the local SBDC offices are prepaid services. That's what we want to say here. Prepaid services. So you want to make sure that you're looking to your local small business development centers to make sure that you're getting the assistance that you need to help you with your business.
Absolutely. Your tax dollars at work.
Exactly. Anything else that you would like to add for our audience, Sybil?
Not right now, unless anybody has a particular question.
And I don't see any more popping in. So I'm going to end our recording right now, but we will leave the polls open in case you need to complete them or check with our